Let's get in a very special market voice. Taher Badshah, Chief Investment Officer for Equities at Invesco Mutual Fund, joins us right now on the show. Taher, good morning. Many thanks for joining in. This is Neeraj here. Good morning to you. Taher,
good morning.
Back in...
Thank you for having me.
Pleasure having you. Back in March or April, Taher, I remember we were talking about concerns that could be ailing the market. And we spoke about how some of these have not been fully addressed. Fast forward the time to 2 or 3 odd months, these concerns haven't been addressed even now. I mean, whether it's the domestic concerns or whether it's the global concerns with regards to crude or trade wars, they're still up there in the open. How are you approaching investing in such a scenario then?
Yeah, so, of the couple of concerns, global concerns that you mentioned, obviously one is something which we have to reconcile ourselves to, which is essentially crude. We don't really have much that we can do about it. It's at one level, while taking investment decisions, a certain higher level of crude was prognosticated from at least the beaten down levels of around 50 over a period of time. What has, however, caught probably all of market participants a little off guard is the fact that the intensity of the rise in crude in a very short period of time, from 55 odd to 80 odd, has been something which was not expected. We are probably looking forward to a more gradual increase. So that's come in as a negative surprise, and it's taken a toll on some sections of the market and certain stock constituents, and even it has hurt us as well in some of our portfolio positions. But nonetheless, I mean, we believe that there are some of these franchises who are, while affected by oil, will probably be able to kind of pass it through. So, and that's eventually what will happen at across all industries which suffer on account of direct oil or oil derivatives, because if it is driven by rising demand, then there is a situation that you might be able to pass on to customers. So that's one way to take care of that, and that will be known over a period of time as we see pricing power. But the other thing, which is about trade war, and the noises have escalated, and we still to see actually anything still significantly being implemented on the ground. The dates which have been given are still in the next month. So we'll have to see as to what eventually comes by. But there is clearly heightened activity. Now, are we as India, as a market, are we in the immediate crosshairs of this exchange? I don't really think so, and we know that. But the thing is that obviously it is enough to spoil sentiment, and especially in certain parts of the market which are probably overvalued, that impact is seen to be a little more pronounced. So I think that's how I don't really think we are positioning ourselves to defend ourselves against this trade war related activity. But yes, I mean, we're trying to see if we can defend ourselves in terms of who are the companies who have pricing power in order to pass on higher input costs.
Taher, a lot is being spoken about with regards to the kind of pessimism that has now started to creep in at the broader end of the spectrum. I agree there was over-optimism on the upside when small caps and mid caps flew around like there was no tomorrow or no negative news in the offing. Are you in the camp which believes that the correction that has now started to come in or has already come in and seeped through across the spheres is also a bit overdone? Or would you believe that this could well be the trend for the next 6 odd months as well, that stocks by and large could get punished meaningfully?
It's possible, but we might see some more downside to the broad basket as such, and sentiments might remain a little low. But increasingly, some of the things are coming into pockets where we would like to assess them, and we are increasingly kind of looking to assess some of these companies which have corrected and valuations have come off, and maybe they were attractive in the first place, but we were being held back because of valuations. So you are right that 6 months ago, many of these in the mid and small cap space were clearly untouchables, and for a very long period of time in the last 1 year or so, we've been kind of maintaining a little more bias towards the large cap space and the larger mid cap space, so to say. But having said that, yes, over the last couple of months with this kind of correction that we have seen, we are seeing at least some of the things come into a reasonable zone. Are they cheap yet? Certainly not. But at least they are at a stage where they can be evaluated, and they've come out of at least a situation where they were almost touch-me-nots. So we are happy to look at some of these names. We are finding a few scattered areas in different sectors. Could be ancillaries, could be auto ancillaries, it could also be certain consumer discretionary. It could be some NBFCs which are coming into that range where we probably might be a little more interested than what we were 6 months ago. But are we looking at it from a 6-month perspective? Certainly not. I mean, even if we were to buy some of these today, we have to take a slightly longer call, maybe a year or more than a year, in order to expect the returns that we want to generate. But yes, they are clearly becoming somewhere there is a certain amount of attraction which is coming about in some of these mid and small cap names.
Okay, you will continue the larger conversation as well, Taher, but just an off-the-cuff follow-up. When you're talking about finding these scattered pockets, and you refer to maybe say auto ancillaries as well, the pain is clearly out there in companies which have global exposure to companies and to countries as well. Is that the area where you're finding some favor? Because the domestic exposed, CV exposed auto comps haven't performed all that poorly.
Somewhat, yes. I mean, there are, I would say that there are also, along with certain global ancillary suppliers, etc., which are linked to the global supply chain. There are some which are also linked to the domestic supply chain. And again, as I said, scattered and, one-off kind of opportunities in segments which we believe are reasonably less prone to disruption going forward, and probably less prone to new trends in the market and EVs, for example, and so on. So to that extent, and cyclically in the right direction as well. So there are a few domestic opportunities also. I wouldn't say a few, in fact, a couple of them, in fact. So I would think that is where our focus is. And yes, some of them have corrected on valuations, and they've generally been relatively better quality businesses, and the way they've handled volatility in the past has been quite well regarded. So I think that's the reason why we are kind of attracted to some of those names.
Right, Taher, good morning. This is Agam. On a year-to-date basis, the Nifty has advanced by approximately 2%. The NSE 500 has declined by 2%, and the BSE mid-cap space has taken a knock of around 12%. You did speak about the divergence between the large caps and the small caps in terms of prices. My question then is, and while you have to a certain extent spoken about some opportunities out there, can you tell us a little more about the pockets which could see a substantial up move based on the your earnings coming through for FY19? What are these pockets, and if you could tell us a little more about that?
Yeah, so you bring up an important point, and essentially from a market mood perspective and overall sentiment perspective, I think what can probably negate the current scenario of current skepticism or pessimism which is there in the market is clearly the first quarter earnings season that will be due in the next couple of weeks' time. And I think this will be important. This quarter will be important in a way from the fact that demand trends have started to look up in the last quarter, which is March quarter, and there is an expectation that some of that trend will continue into this quarter as well. Plus the fact that this is the first quarter of fiscal 19, and it will kind of set the momentum and tone for FY19, on which there are certain expectations in terms of earnings delivery from the overall market compared to what it has been in the last 2 years. So I think it will provide a certain amount of confirmation of trend as well. Sectors to which we would probably look forward to once again are, in things area. I mean, the usual suspects would obviously support the growth. For example, the private banks, and you will probably see even some consumer discretionary stocks, certain autos, certain consumer staples, some parts of the NBFC space, and so on. So you will see those supporting the overall growth. We also need to look to what happens to the cyclical components of the market, and which have kind of contributed significantly to the growth of the earnings in the last 2-3 quarters. They will start facing a little bit of the base effect related hurdle. So some of the commodities, industrials, etc., we need to see as to where they end up. We would like to see some improvement in the trends on certain corporate banks, corporate focused banks, in terms of NPA levels moderating or provision levels moderating a bit. So I think these are the spaces which at one level will kind of set the tone for the rest of the year, and that is where I think the investor attention also has been in the last 3-4 months, and investors would therefore want to look for further affirmation and confirmation of trends in those areas.
Taher, and finally, your view on the RBI interest rate trajectory. What is your anticipation here for the upcoming year and its implications on equity markets?
So a general house feeling is that we probably should have another round of 25 odd basis points probably before calendar year 19 runs out, calendar year 18 runs out, sorry. But we don't really see anything beyond that immediately. The fiscal or the inflationary trends and do not really suggest anything beyond that. I think what we saw as the first instance of 25 basis points was also probably more guided by a hardening of global yields, and not as much on account of fears on domestic inflation, which is still reasonably range bound. So we'll have to see. We'll have to probably watch more of the global space in order to see what RBI would likely do than not just be colored by what's happening in terms of the domestic market. But so global will play a bit of a role. But from what we can decipher, at least out of domestic indicators, it doesn't look like there is a need for anything more than a total 50 basis points for the calendar year as of now, and that's what probably bond markets have also priced in a way.
Taher Badshah, thank you so much for joining us this morning with your views on the markets.